How to value a startup with no revenue? So let's say you started today and you need the valuation of your startup for initial funding or the seed round. So how to value a startup? Like is it a pre-revenue or don't have any type of the revenue? So pre-revenue startup valuation can be tricky. Like there are the many things to take into consideration from the management team or the market trends to demand for the product and the marketing risk involved. So after the evaluation of everything, even with the most effective pre-money valuation formula, you can hope. So let's say there's a difference between the valuation and the mature business valuation. So startup valuation is the process of calculating the value of startup of a company. Like startup valuation method are the particularly important because they are typically applied to startup companies that are currently at the pre-revenue stage. As business owners will hope for the high valuation, whereas the pre-revenue investors would prefer a low value that promises a bigger ROI on the startups. So, how does the pre-revenue startup valuation compare with the mature business? Unlike the early stage startups, a mature public listed business will have the more hard facts and figures to go on, and the steady stream of the revenue and the financial report make it easier to calculate the value of a business. And this is usually done with the EBITDA formula, which calculates the value of the company based on the earning before the interest, tax, and depreciation (EBITDA). So, assigning a valuation to a startup company with a no revenue can be a challenge, but as you don't have any figures in the hand. However, while the most startup valuation method don't have the details on the profit, tax, and amortizations. So more often that, like the early stage startups are valued somewhere in the middle. Meanwhile, founders don't get quite as much as they anticipated, and the investor pay more than they initially want to invest. And transaction is the proof. Like if you are wondering how to value a startup company with a no revenue, so one of the main indicators is attractions. Like you get the true value, true story of the businesses by looking at the following: number of the users, proving you already have the customer essentials, and the more the better. Effectiveness of the marketing, if you can show like you can attract the high value customers with a relative low acquisition cost, you will also attract the attention of the pre-revenue investors. And your business has a grown small budget, like it's a great, like many investors will see the potential for the growth if you have the small financial backing. So there's a common thread between the three concepts. Powerful marketing strategy will lead to impressive growth, and the numbers will be such. By providing the proof that you have a viable, scalable business idea, you automatically add the value to its businesses. So pre-revenue investors want to be sure like they are backing a team that destined to success, and the proven experience. If the team include the people with the prior success with the other startup venture, it will be more tempting for the startup with a full of the inexperienced, first timers. Skill diversity. A startup team has a mix of the experts who skill complement each other, and the prodigious program cannot do anything alone. If the marketing expert is also there, and apart from the sales person is also there, so that would be good. And the commitments, having a great people is also a part of puzzle. Like these people need to have a time dedication to make sure their startup gets off the ground, and the team part-time employees will not be attractive. So apart from that, like the prototype or the MPV is the another factor. Like if you regardless of the pre-money valuation, like you have to work on the prototypes, and the formula is a game-changing additions. Being able to show the pre-revenue investors a working model of the product is also proof that you have a good startup, and the minimum viable product and the early adopters is also a good. Supply and demand is also a factor. Like if a product has the higher demand, and apart from that the supply is limited, so you can be a game changer like in the industry. Apart from that, the emerging industry and the hot trends will be a good. Like in the booming industry like AI and mobile gaming, many investors will be more willing to pay a premium, and the digital age is alive with opportunities, and people view as the next big thing like the startups. High margin is also a good thing. Like product with the low profit margins are less attractive for the investors compared to the product with the high profit margins, and the promote the forecast for the future sales is the revenue growth may be commendable for that. So these are the some techniques like the investors value a startup with a pre-revenue, and that can be good for that. So for the more content, you can subscribe the channel and like the video for the better reach. So let's meet in the next video. Bye bye.